Yeah, let's get some more analysis on this one, guys. Joining us now is Amanda Agati, PNC Asset Management Group Chief Investment Officer, and Lakshman Achuthan, ECRI co-founder. Guys, good to see you this morning. Man, let me get right to you. Saw the futures tick down on this report. Is this report the worst possible scenario for the bulls?
Hi, well, it's great to be with all of you this morning. No, I don't think this is the worst possible scenario at all. In fact, I would call it largely neutral in terms of the market and the market's path forward. I think it gives the Fed enough license to continue to be aggressive around rate hikes from here. So market expecting 75 bips in July here. I think based on what we're seeing in the report, that makes sense here, but I don't see anything here that makes me think they need to go more aggressively than this.
Lakshman, what do you believe the most important component of this report is that the Fed is paying attention to?
Well, just building on the comments, the Fed is going to stay the course, right? So they are, this is giving them confidence to continue to hike rates. That is a difficult path because the economy is slowing actually pretty dramatically, even though the jobs report is coming in stronger than expected. Those two things can exist at the same time, in particular in the run up to recessions. So that is the course we're staying on. I think the market is trying to figure out, how bad it might be ultimately. But this is very much the quick takeaway is Fed is staying on course, as was just mentioned. 75 basis point hike is very much live and on the table. And that's happening into an economy that is decelerating.
Lakshman, is it time to just chill out a bit on all these recession calls we're hearing from the street? Look, I know jobs were revised down in April and May, but we still created a good number of jobs. The jobs report today came in better than expected. I mean, this is not a recessionary economy.
Today it is not. I 100% agree. I think, the street is getting ready for the announcement of 2 quarters of negative GDP. And so they've got to have at least one foot on that recession kind of discussion. And so you're seeing that coming out and there's plenty of, clickbait around recessions. When we look at what a recession is, right, it's a vicious cycle where you have falling output, sales, income, and falling employment. We do not have falling employment. It's very clear we do not have falling employment. There are certain reasons in the post-COVID environment where it might be taking a little longer to show up. It's not unusual if you look at past history over decades to see the employment market pretty tight in the run up to recession. So those two things, as strange as they sound, can exist. You can have a tight labor market in the run up to recession.
And so, Amanda, with regard to where the worker sentiment is right now on the front of wages, there's, of course, a lot of thought that is really mirroring perhaps the words of Fat Joe saying yesterday's price is not today's price. And so for workers that are out there that are looking for their wage increases to match the inflationary pressures that are being seen, where do you expect to hear more from companies about how they are navigating that broader employment situation and that dialogue on the wage front?
Well, we're definitely fixated on that as a key theme going into Q2 earnings season. It's about to kick off next week, and that certainly is going to be an area of pressure for sure. We've already seen it. Wage increases have been very much lagged relative to where the inflationary backdrop in the economy is. So we expect to see more pressure on that. I think on a relative basis, though, if we look at profitability for the S&P 500, we're sitting near all-time highs, not even just cycle highs. And so even though we are expecting some pressure from a profitability perspective, there's more headroom this time around than perhaps in past cycles. And so while we may see a little bit of pressure from guidance, we may see a little bit of pressure from earnings growth trajectory, we still think companies are pretty well positioned to be able to pass through continued wage increases. There is going to come a tipping point, but I don't think it's necessarily in Q2 earnings season.
Lakshman, if we are having this conversation 2 months from today, what do you think that jobs report will look like?
Well, look, if the recession, we believe that the recession probability is very high here. And if that's correct, sooner or later, jobs will have to have a clear step down. And I don't know if that's going to happen in a couple of months or in a couple of quarters. There's no precision exactly right there. But the odds are very high that it is going to happen because the forward-looking data, the leading indicators, employment is a coincident to slightly lagging indicator, okay? GDP is a lagging indicator. Sales and income, all of these are coincident to slightly lagging indicators. The forward-looking indicators have been decelerating very, very clearly, and they anticipate these directional turns, these dislocations. And the message is very, very clear that you are going to see a continued easing here. And you know, if you've got a couple of quarters negative, you could try to rationalize it in GDP and say, oh, it's nothing, it's this or it's that. But you know, these things, a few in a row, start to become a trend. And jobs growth, as strong as it is today, and it is, I'm not disputing that at all, still in a decelerating trend. Average hourly earnings, even though they're very strong, they're still in a decelerating trend, and real earnings are actually not that good.
We're going to continue this conversation in just a moment here. We're going to be back with Lakshman, Achuthan, and Amanda Agati, so stick right there for us.